Okay, today we're going to talk about monetary policy. And you can see by the definition we have in the corner that monetary policy is the Fed's use of changing the money supply to alter the interest rates in the economy and then stabilize the economy. And so what we have here are the three monetary policy tools that the Federal Reserve has available to them to change the money supply. Okay, so monetary policy is all about changing the money supply. The tools that are listed are the tools that are available to change the money supply. So tool one is the required reserve ratio. And so the Federal Reserve can change that required reserve ratio to change how much banks have to hold on to. Or you could say to change how much banks have available in their excess reserves. So just remember that when banks hold on to more or less, their excess reserves are going to change, which either increases or limits their ability to loan money out. And by loaning money out, we're either increasing, or when we don't loan it out, we're decreasing the money supply. Okay, so that's tool number one. Tool number two is what we call the discount rate. And the discount rate is the interest rate that the Federal Reserve is going to charge banks. And the Federal Reserve can raise and lower that to either encourage or discourage the Federal Reserve from going to the Fed, from banks going to the Fed and borrowing money. So when we raise the rate, banks don't go there, so they don't have as much available to loan out. When we lower the rate, more banks are going to go to the Federal Reserve, which then allows them to have more available in their excess reserves and then loan more money out, increasing the money supply. And the last tool is the most important for sure. We call this open market operations. And this is the Federal Reserve's use of buying and selling bonds to banks. So simply put, when the Fed sells bonds, it's going to lower the money supply, or I like to say sell bonds equals smaller bucks. And buying bonds is going to increase the money supply. So when we buy bonds, bigger bucks. But the real process here, if I draw a balance sheet, let's try that again. We have our liabilities and we have our assets. And let's say that this bank has $1,000 in deposits and liabilities. And then that money is split up into required reserves and excess reserves. Okay? Let's say that of the $1,100 are in required reserves. That would mean 900 are available in excess reserves. So when the Federal Reserve wants to shrink the money supply, they will go out and they will actually sell bonds to banks like the bank that we have listed here. And when they do that, when they sell bonds, let's just put over here, we're going to sell bonds. The Federal Reserve is going to give this bank bonds. So say bonds are now going to equal $900. And the Federal Reserve is going to take their excess reserves away. So the bank is going to give their excess reserves to this money is going to go to the Federal Reserve when they sell bonds. The Federal Reserve is giving them the bonds, but now the banks don't have that money available to loan out. So we can change this to $0 that are now available in excess reserves. And so in a sense, the bank is going to make money off of those bonds still because bonds pay interest over time and they're going to get their money back. But in the current moment, banks cannot loan that money out. The Federal Reserve is taking that money away from them. So the excess reserves at banks are smaller now or taken away. And so in the banking world or the banking system, we have less money available to loan out. Therefore, we can't create as much money. And so we say then that the money supply is going to shrink because that opportunity to loan money is taken away. And on the flip side, when we want to increase the money supply, the Federal Reserve is going to take those bonds away, scratch that out, and they're going to give them their money back. So now all of a sudden, we can do this right. All of a sudden now, the excess reserves has increased back to $900, and now this bank has this money available to loan out through the process of Fed buying the bonds and giving them back their excess reserves.